All right, we're good.
Okay.
Um, all right, so start off with a quick prayer then.
Yeah, I can give that.
All right, sounds good.
Okay.
Dear Heavenly Father, we're so thankful that we could meet tonight. We're so thankful for the lessons that we've been able to learn this week, and please bless that this meeting will be beneficial for us, and we say these things humbly in the name of Jesus Christ. Amen.
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 All right. Any spiritual thoughts?
Well, just read in the Book of Mormon. I was reading about the importance of the records of Isaiah that we have, and also all the prophecies that he made, and also the importance not just to read the prophecies of Isaiah, but as well to understand those. Because I was remembering that on 3rd Nephi, Jesus was teaching that the words of Isaiah are very important for us. So we need to study those because we during this time, we are the accomplishment of those prophecies. So I was trying to get more in depth with my reading and the scriptures of Isaiah and the importance of those things for my life and also for everybody's life today.
Yeah.
Thank you.
Awesome. Thanks for sharing that. Okay. So let's just jump right into it. Question 3. Put yourself in the shoes of Brentwood Associates Management. You must decide whether or not you will exit Zoe's Kitchen now, and if so, what is the best exit option? As a group, vote what should Brentwood do with Zoe's Kitchen.
I vote for them to wait and grow the business until it is more valuable.
I said IPO, just because I feel like they're pretty big now. It mentioned that their store count's at 102, revenue is 116 million, EBITDA is 11 million, and then they said they had 20 different investment banks that were asking about Zoe's and whether they're going to go public or not soon. And then it also mentioned that they can file an initial S1 confidentiality, which means they can kind of test going public before anyone sees their numbers. We can see if that's something that's really that would be beneficial for them. And then it also mentioned that in the past 4 years they have grown, I think, like the same amount as Chipotle, and Chipotle is like one of the leading fast food restaurants. And
I think it said they were even growing faster than Chipotle. Like Chipotle was the only one close to their growth rate.
yeah, I think it was something like that. I think you might be
Yeah.
right. So that's
Yeah,
I
I was on the same page with you, Kevin. I thought they should just go directly into the IPO process.
Yeah, and then I also noticed too, it says if they go public, they could get more money if they were bought out.
Yeah, a lot more.
Yeah,
Like,
they made a comparison with Yard House.
They
said Yard House was bought out for like 20 times
the EBITDA.
Yeah.
Yeah. When typically, if they sold out right now, a typical company right now would sell between 8 to 13 times that.
Yeah.
But they could go get up to 20, 21.
Yeah.
I was thinking that too. So I guess that's basically jumps us right into question 4. As a group, allow each individual to state his or her position. If you all agree at the outset, take a counter position and explore why you should consider those other options. So why does Brentwood want to exit now? What are some reasons for holding now? What can go right under each scenario? What can go wrong? So Kevin, why do you think they should wait a couple of years?
Not really a couple of years, but some time, because as well, if they go with IPO right now, the process will take them 3 months. I was reading the IPO process and it says that it has taken about 3 months from the start to finish, since they need to fulfill several requirements. So I think if they are making that amount of money just now when they got the investment and increasing and having 94 restaurants and 8 franchises, I think they can increase a little bit more their value. So when the time comes and they are able to make the initial public offering, they can get a better valuation since they are getting a very good growth rate. So maybe a year to grow more and get a better valuation. But now, because on the case says that this will be the first time they will make in this process. So one of the risky things will be for them to get a lower valuation or a lower public offer price.
Right.
Yeah, that's a good view. I was kind of looking at the IPO process a little bit, and to me, it just seemed like, because like you were mentioning, Kevin, their growth rate was exceptional. I'd have to go back and look, but it was like really, really high.
Yeah, it was.
Where was it at? Now I'm curious just to see it again.
The Chipotle one?
No, the growth rate of Zoes. I think it had it in there. Oh yeah, okay. So their growth rate. Maybe not. I'm trying to find it. I know the Chipotle one was really high. But yeah, anyways, their growth rates were really high. If they went with the IPO process, they were able to sell out at 20 times, about 20 times their EBITDA, which I thought was like crazy.
Yeah.
Which could be double of what they could do right now. So if they went with the IPO, they could sell out for probably double, and be considerably better off.
Right. And correct me if I'm wrong. I don't know if I read this right, but it said, and this would be against the IPO. It said their expenses, and then they would have a $1 to $2 million annual recurring cost.
Yeah. But by doing that, if they do go through the IPO, then at that point their financial situation is basically covered by
That's true.
selling out public stocks.
Right.
So yes, they do have that $11 to $13 million upfront cost to start out as an IPO, and they do have the $1 to $2 million in recurring costs. But it says they're well on the by the end of August, or by the end of 2013, they're well on their way to generate 11 million.
Right, and that would be the thing that would be cover their $1 to $2 million, right?
Yeah, it would cover that, and they would still have plenty of room for growth. Plus, on top of that, they're selling stock to the public and gaining a lot more at the same time, which would allow them to grow a lot more rapidly, kind of like Noodles had just recently done. And it says it, and I looked it up, it says it takes 6 to 9 months for them to become, if Zoes were to go public in the coming months, oh wait, no, that's not it. Okay. So the process to go public usually took 6 to 9 months. So, I mean, it's a long process. So if they're going to do it, I think they should just go for it right now, jump right into that so that they can get in that market buying where people are like how they're buying noodle stocks like crazy, how they had just done that. And it's a really good opportunity for them.
And then another thing that I forgot to add, they're adding in 30 more restaurants next year. Well, what would have been 2014.
Yeah.
Yeah. Seems like they're growing quickly.
Yes, they are.
Yeah. So yeah, I think they should just go and do the IPO.
I agree.
Okay. If we think that they can start the process, well, I will agree with that process as well.
116 million. I'm just looking at some of the other stats real quick, just because they're kind of interesting.
I wrote some of them down. It says, so a private sale could be completed in less than 3 months.
Yeah.
They also mentioned that poor performance by competitors, like let's say Noodles had poor performance, and all these stock people, like the investors, got kind of antsy and were afraid, and so they could actually go and take people and start selling stock for Zoes. So their competitor can actually have a negative impact on the stock price.
Yeah. That's true. That's an interesting thought as well. I hadn't even considered that, but
I wouldn't even think because if Samsung were doing poorly, I wouldn't just automatically assume that Apple was doing poorly.
yeah.
I would think, oh, Samsung's probably doing poorly because Apple's doing so well. So maybe I should go invest money in Apple. I don't know. It seems a little weird to me.
Yeah. Yeah. So let's I guess we kind of all shared our points on why we should pick that. I guess we can just go to the last question, which is how much is Zoes worth under each exit option? Discuss with each other how you got your answers as a group. Come up with a consensus as to what Zoes or Zoes is worth. So if they sell out now, what are they worth? I mean, if they sell out by the end of, because it's like August 2013 right now. If they sell out by that fall or that November or so, they're looking at their revenue being about, well, because it says that they sell out at about 8 to 13 times their EBITDA, and their EBITDA for 2013 was projected to be, I'm going to hurry and go to it. Clear down on page 17. So 10,899,000. 10,899,000, and you times that, it's 8 to 13. So let's just say 10.5 times 10.5. They could sell out for $114 million in November.
Wow.
So that's in November. I'm gonna write that down real quick. 114,439,000. That's so much money. That's ridiculous.
That's a lot.
But if they go with the IPO, I mean, I'm not sure. Maybe I need to go back and read it a little bit more detail, but I don't understand the full process of selling. You're going like exiting going through the IPO process.
Yeah.
Would you just take that years of the 2013, or would you wait for a following year because it's going to take about a year?
That's the one thing I'm not sure about.
Yeah.
I actually did look up Zoes. They actually went public, and
Oh, did they?
Yeah, they were initially priced on April 11th, 2014.
Huh. April 11th, 2014, and it's August at this
Yeah.
point in this case. So September, October, November, December, January, February, March, April. 8 months is how long it took them. So, I mean, just going off the revenues, the earnings before interest and taxes, and then I don't know what DA stands for.
Yeah, I don't know either because I've only heard it as EBIT before.
Yeah, I'm gonna hurry and Google that. ITDA. Oh, okay, yeah, it's depreciation and amortization.
No.
Amortization. So that's your earnings before all that, the taxes, the depreciation, and the amortization. So I mean, even if we're going off that year, the 2013 earnings before interest, depreciation, and amortization, then, and if they sell out, let's just say they sold out for 20 times that, that is 10,899,000 times 20. That's 217 million. That's quite a bit more than double. Or not quite double, almost double if they just traditionally exited out.
And then I guess you probably subtract the 10 to 13 million and then the 1 to 2 million. And you'd still have quite a bit more.
Yeah, so let's just say it cost them 13 million to sell it immediately. That following year they spent another 2 million. So you minus 15 million at that, they're still at 202 million.
Right.
Plus selling out, that'd give them a lot more money to increase their growth, open up that other 30 stores, not have to go to the General Electric to get their credit line increased. And I think it would just be a great opportunity for growth. Like it said somewhere as well that in this case, let me find it. What's his face? His name starts with an A. I don't even know how to say it.
Oh, the main guy?
The representative guy. Yeah. The representative guy was saying that deciding to do an IPO, if the managers are against it, then he said it's like a really bad idea. But the managers were saying that, I think I copied and pasted it somewhere even. Oh, they just management saw considerable benefits by going to an IPO, thinking that they would be marketed out in the market. They would be out in the market better. They'd have better employee trainings and something else in there as well. But I thought that was interesting. So yeah, as for worth, I mean, there's different ways to basically put worth on a company. But if you're talking sellout price, the sellout price or the exiting out price by going with the IPO option is considerably higher for Brentwood. And I think that's a way better option for them.
So imagine too, why would anyone sell to a financial buyer instead of IPO? I mean, I think if you were to sell to a financial buyer, it'd be if they were smaller. Like if they were significantly smaller, then it would be smarter to go with a financial buyer.
because
Yeah,
we're
I
valuing
think
the company with a less amount.
yeah, I think if they were going, if they were smaller, like you were saying, but also another reason to sell to a financial buyer is there's no risk involved as well.
Okay.
It was saying like, because like you sell out and at that point you're done. But it was saying like if you switch the company to a publicly owned company, there's also a considerable amount of risk involved with that. Not a ton of risk, but obviously there is a lot more risk than if you just sold out immediately. So obviously you take the risk, you can get higher returns basically with any other thing we've talked about throughout this class.
Mm-hmm. To support that point, because we were ending that they will get if they will go with an IPO of $200 million, and this is by 2013. And in the case that each restaurant was generating a revenue around $800,000, we have 30 more by 2014 because the process will take around 3 months. It is generating like around $25 more million. So it will be in the end like $225 million. And let's say if we go with a financial buyer, they will give us, let's say, 50 or $60 million less. So by getting that money less, it's not worth it just to have no risk in going with an IPO. So that could be another thing that we will be able to generate more with an IPO and generate more revenue with 30 more restaurants, and instead of just going right away and sell it.
Agree.
Yeah, absolutely.
Is that all the questions? Or did we get all?
Just 5.
Yeah, that's really it. I mean, if I guess we could kind of talk about like more of like the worth of the companies, but I don't really know how to put a better worth on the companies other than to talk about like the worth for Brentwood at that point, like selling out if they exited out right now and sold it to a financial sponsor to buy them out, or if they just wanted to switch it to an IPO. I can't think of any other way to put a.
I kind of read the initial public offerings attachment, but then it kind of gets down to these equations that kind of went way over my head.
Yeah, I kind of skimmed over that yesterday, and I was just like, I'm gonna focus on the case, and then maybe I'll get to that if I have more time.
Yeah, that's what I looked at it first, and I was like, whoa, and then I was like, I'm just gonna read the case.
Yeah, I mean, I got a little bit out of it. Like I feel like I like some of the introductory parts were pretty good, but I felt like the case itself explained the IPO process fairly well.
Yeah,
I mean, because I didn't know anything about that until I read this case. So, yeah.
Yeah, I mean, I think our best with the numbers we're given, based off Yard House selling it for 20 times the EBIT, and if we use that as kind of our formation of worth of the company, then yeah, we get about 202 million.
Yep.
Yeah, I'd say that's probably worth. To be honest, at this point, I would say they're probably worth around 200 million.
Yeah, which I think, and like we've said a couple times already, I think it just allows Zoes to grow a lot more rapidly, get those other 30 restaurant buildings out there that they wanted, and there's also been plenty of interest in buying those shares of the company in a public atmosphere already, because they had like 20 different was it like financial investors that had contacted them, or
bank guy? Like, let me see.
Yeah.
It said 20 different investment banks asking if Zoe's might
That's
be
what it was.
going public.
Yeah. So I think that's the best decision for him.
Yeah.
I agree with that.
All right. So quick summary. First question was, okay, so we've decided to that Brentwood Associates should go through the IPO process now and get started with that, because it would be better for the company in a long-term status, and companies that go through an IPO tend to sell at 20% or 20, it's not 20%, 20 times the EBITDA.
Yes. Yeah, now the other thing that we agreed, it's for them to sell it now because the growth rate they are having, that will allow them to sell it by $200 million at this time. And even though to go with an IPO process will be kind of risky, it will be worth it if they were able to get that amount of money. So that's one of the things that they would like to go with this process.
You also mentioned that they could get more investment money if they went public, and they would be able to expand and add additional 30 restaurants that they're wanting to do.
Mm-hmm.
Yeah, and along with that, then they wouldn't have to go to their General Electric financial provider to increase their credit line and do that as well. Also, current management at Zoes also thought that there would be a lot of benefits by turning itself into a public company as well. So that was also a benefit that the current management thought it was a good idea.
Yeah. So a couple positives for the IPO: to increase visibility, it attract and retain employees, and provide permanent source of capital to fund store growth.
Yeah, perfect. Those are great points. So, and then the other question was, I mean, if we didn't think they should do switch over to an IPO, some reasons for exiting now, and selling to like a financial, I can't remember the exact term, but just sell it. Yeah. But just selling it out now, there's like hardly any risk involved. The fees aren't very high. I think it was like $1 or $2 million to just sell it now, and then they're done. There's no risk involved with that.
Yeah, you mentioned earlier 114 million by November.
Yeah, perfect. So how much is Zoe's worth? If they were to exit as an IPO, they'd be worth about $202 million at that point, almost maybe around 203 almost, $202.98 million. And then if they were just to sell out, it would be worth around 112 million or 113 million, depending on how much it takes, whether it's 1 or 2 million. Worst case scenario, they come out at 112 million.
Sounds good.
Yes.
Cool. All right. Well, I think call it good then, and we're done.
All right, cool.
Yeah.
Okay.
All right. Hey, thanks a lot, guys.
Yeah, thank you.
Yeah. See you next week.
Okay.
Yeah.
Goodbye.